to this research. We are looking at 36 Morningstar sectors, and we're asking ourselves the question of what is the correlation of financial ratios to market valuation, and which ratios are the most important for which industries, because we firmly believe that we can't put all industries in a spreadsheet and shake them up. And we also believe this is not a beauty pageant. This is about real companies doing real work, and we wanted to create an index that would allow us to compare little companies to big companies, to compare companies across currencies, and it's for that reason we're not looking at absolute numbers, we're looking at financial ratios. So for that, let's get started. Supply Chain Insights is a very small, focused team focused on delivering independent and actionable and objective advice for supply chain leaders. This is a bootstrap startup. This is not something that a technology vendor has paid us to do. This is something that we are committed to doing for the supply chain leader. It's independent, we want to make it objective, and we want to make it actionable. I'm very pleased that I'm able to work with a wonderful team. Today, Abby Mayer joins me, and Abby is the arms and legs and brains behind this work, along with a couple of summer interns and a couple of special people on the Supply Chain Insights team. Good morning, Abby. How are things in New Mexico today?
Good morning. I'm excited to be here. Thank you.
Now, Abby, you've been working so hard on this, and we've got so much great insights. Let's just go ahead and get into it. You know, I first started working with Abby in the writing of the book Bricks Matter, and the book Bricks Matter has now got 15 five-star reviews, and it's on its second printing. And what Abby and I wanted to do, and we were a little naive at the time, was to start to put financial numbers into a spreadsheet and start to work on the correlation of market valuations. And it almost seems ludicrous now, Abby, when I think about how naive we were when we first started this process. We had to really find the data. We had to look at what data was available and understand the nuances of the data. And Abby, we've just learned so much. You know, when I look back and I think about the first work, I mean, I can't wait to finish it for our global summit in September. And one of the things that we are working on is publishing a second series of books with the new information that we've learned called Metrics That Matter. So if you miss the webcast series, or if you're not able to read all of our reports, or you're not able to listen to our podcast, you will see that in the summer we will be publishing 2 EPUBs, and then that will actually become a hard copy book in 2014. We want to help supply chain leaders talk the language of business. And in that, we publish open research, 18 reports in 2012, and we published a series of Metrics That Matter reports that really look at each industry. And in these reports, what we were trying to do was to understand the trade-off that leaders had made in each industry sector between growth, profitability, cycles, and complexity. And we actually found some amazing patterns as we started. We wanted to see who was best in class, and we defined best in class as a company that could perform better than peer group, the company that had year-over-year results. We don't believe that it's 1 or 2 or 3 years. We think that you need to look at a longer series of time. We're arguing if it's 5 years, 6 years, or 10 years, but it's very clear that it's not a short period of time for supply chain leaders. There needs to be internal alignment on metrics so that it's cross-functional and it ties to the horizontal processes of revenue management, sales and operations planning, supplier development, and corporate sustainability. And there has to be a clear business strategy and consistency in results. The companies that do it best were resilient through the recession. They were resilient through the growth periods. And they use innovation in driving the supply chain processes while retaining balance. And the concepts of balance and alignment, as I have done this work with Abby, have become really a very different definition in my mind. I think that they're really coming to life. And let me help you understand what I have learned. So first, when I was writing the book Bricks Matter and I did the interviews with 75 supply chain pioneers, one of the things that became very clear to me is that a supply chain is a complex system with complex processes with increasing complexity. And as I worked through the 98,000 words in Bricks Matter, one of the things that I really pushed back on myself to say was, I had written about complex processes, I had written about increasing complexity, but I hadn't really dealt with the complex system nature of the supply chain. And what I wanted to do was to be able to represent trade-offs. And so my first representation of this concept of the effective frontier was this one that said, every supply chain has potential. And that potential is based upon how we balance revenue and cost of goods and working capital and corporate social responsibility and our asset strategies in both bricks and mortar and also in asset strategies. And then we get to the ability to drive our planning processes with forecast accuracy, customer services, and inventory. And unfortunately, in the industry today, we don't have good data on customer service. If we look at customer service metrics, most of them are overstated, they're self-reported. And, you know, basically the pioneers tell me that we haven't really made that much progress on customer service. Recently, we have two sources of good forecast accuracy data, the Terra Technology benchmarking and the Chainalytics benchmarking, but they're just in the last couple of years. And that data says we have not made much progress in forecast accuracy. And so what Abby and I wanted to do was to say, had we made progress in the balance sheet? And if so, which leaders had made the most progress and why? And so we built a database of 20 years of financial data. We learned quickly that it couldn't just be about absolute numbers, that it had to be about financial ratios. And we organized the ratios into columns where we started mapping the trade-offs of the ratios in each of the industries to look at, are there clear winners? And how did companies define supply chain excellence? Sounds easy, but it's not. We found that some companies did very well on revenue per employee, and others did well on cash to cash. But the ability to push all of these metrics up at the same time and have balance and to increase potential was only reserved for very few. We see in the consumer packaged goods companies that Procter & Gamble did it the best. It's very clear. We can see in mass retail that Walmart did it the best. We cannot find in chemical that any one company did it the best. But today what we want to do is take you on the second chapter of how we're seeing the mining of this data for the supply chain effective frontier, to look at how companies have been able to balance growth, profitability, cycles, and complexity. And just to be clear on the definitions before we get started, today we're going to talk about the supply chain index, which is a formula, and it represents the financial ratios that matter to that industry and correlate to stock market capitalization valuation. What we did was we got 6 years of Morningstar data, quarterly data, so that we could do the correlations against the financial ratios. And then the effective frontier is how the industry has been able to balance the growth, profitability, cycles, and complexity. Each industry has a different potential. And what we're trying to do is understand the potential and which companies did it the best and what drove that improvement in potential. And then through interviews, because we can see the difference in patterns, we go back and we interview supply chain leaders. We want to find out, how did they define supply chain excellence, and what did they do that drove these valuations? So that's our methodology. Now, a couple of things we learned. We haven't improved customer service, we haven't improved forecast accuracy, we haven't improved inventory with the exception of the high-tech industry. But what we have done in all industries except for apparel is we have improved revenue per employee. But you can see that apparel and medical device manufacturers have not made much progress. And you can see that the companies that did the greatest degree of supply chain automation actually made the greatest improvement, the chemical and consumer electronics industries. One of the things that we see in consumer packaged goods and food, which are more in the middle ground, and pharmaceutical, was that they were not able to automate the front office to the same degree that they were able to automate the back office. And so we had a gap there between what we were able to do in the chemical and consumer electronics industries. So all industries are different. They've made pace at a very different rate. We also started to mine data by industry segment, and that we wanted to contrast the columns and the ratios between growth, cost, or profitability, cycles, and complexity. So here we have a contrast of cash to cash and gross margin. This is actually looking at the medical device industry. In this particular industry, we do not find a leader. We actually find that most companies have gone backwards in gross margin and that they've made relatively little progress in cash to cash. And again, for those of you who aren't as familiar with the metrics, we want to take cash to cash down and we want the gross margin to be high. And so this particular industry has been struggling. And if we look at inventory turns versus revenue per employee in the hospital industry, you can see that we're actually making some progress, although it isn't as straight of a line as we see in industries like consumer packaged goods. Each industry has a different pattern. If we take it and we look at a value network, which this is looking at Boston Scientific, Eli Lilly, and a healthcare provider, Tenet Healthcare Corp., and we look at the value networks, we can see that we are not making progress overall in gross margin when we look at value networks. And we're also not making progress overall when we look at cash to cash. Most parties are actually going backwards in gross margin, and most parties are not making a lot of progress in cash to cash. So one of the things that we're writing about is what happened to collaboration? What happened to our concept of trading partners working together to reduce costs and improve cash to cash? And one of the things that I think has happened, because we haven't been clear on the metrics that matter, we haven't really aligned across trading partners, and we haven't looked at value chains as a whole, what we've done is we've typically pushed cost and waste backwards in the supply chain, often to parties who are less able to withstand the pressure, and we haven't moved forward. So it's our hope to help industries to move forward by having a litmus test, sort of like every Saturday I get on the scale and I say, have I made progress? You know, a measurement of health of the industry, and really hold supply chain leaders accountable to move this forward. So we're looking at value chains, and if we look at the healthcare value chain, one of the things that we see is that over the period from 2000 to 2011, pharmaceutical manufacturers actually went down in operating margin almost 29%. Medical device manufacturers improved operating margin by 5%, and hospitals improved operating margin. But days of inventory did not go down, even though revenue per employee did improve. So these are the things that we're studying. But which companies have maximized market valuation through supply chain excellence? And this is where we really get at the supply chain index. So Abby, tell us a little bit about the work that you've done on the supply chain index. Tell us how you went about it.
The supply chain index has been a project that we've been working on for over a year to try to mathematically connect performance in the stock market with supply chain excellence. And so we've been seeking to better understand specific metrics that matter to the balance sheet for specific industries. The second goal of the project was to create an objective system, and so we're only basing the supply chain index on financial metrics which could be found on the balance sheet or the income statement. And then finally, a future goal will be to connect the index work with some of our quantitative surveys to define best practices across industries.
This is very exciting work, you know, but I think one of the things we've got to look at is what it is and what it isn't. So help people with what that means.
Sure. The supply chain index is a way to understand the impact of a company's supply chain compared to its peers within a specific industry sector, and how that supply chain relates to market capitalization based on those specific supply chain ratios. And it's not a way for a company to evaluate overall performance, to compare across industries necessarily, or to compare to actual stock market performance, which you could find on Bloomberg or Y-Charts or Google Finance.
So, Abby, we're in this process. You know, we've got 36 Morningstar sectors that we're doing, and we've got these monthly webinars, and we're going to culminate in the global summit that's coming up. Let's talk today a little bit about why we selected these ratios to start the correlations using R and what you found in the data.
So the first step that we took was to go from about 50 financial metrics to a list of 14 supply chain ratios. And as you had mentioned earlier, we avoided using raw numbers, so we were only using ratios. We also picked metrics, and those are the ones highlighted in red here, that were directly related to supply chain. And we also got rid of duplicates. So there's several different ways you could measure inventory, and a lot of those metrics are within that cycle column. But we decided to just use days of inventory as our one measure of inventory to include within the index.
You know, and Abby, one of my favorite metrics is revenue per employee, but sadly we couldn't use it. Tell the people why that wasn't something we could use.
Yeah, revenue per employee has been really meaningful across industries, but unfortunately it's not widely available within our database, and so we didn't want to build an equation that relied on data which we really weren't able to get at. So that's why, unfortunately, we've had to exclude that from our index work.
If only everyone reported it, right? It's a wonderful metric, but it just wasn't available. So if we move on, you know, one of the metrics that we use is Altman Z, and often when I do this presentation, people will say, what is Altman Z? So Abby, tell us a little bit about Altman Z, because what we're seeing is a high correlation for certain industries with Altman Z.
Yeah, Altman Z has been popping up more and more as we go through different industries, and I think it's one of the least familiar metrics. So it's a credit strength test that gauges the likelihood of bankruptcy for a publicly traded company in the coming years. And it was invented by a finance professor back in the 1960s. And you can see below the definition we have the actual inputs that you would take from the balance sheet and the income statement to come up with that Altman Z metric.
So it's a measurement of risk, and you know, the supply chain I think has a direct impact on this. But let's look at it. So one of the things that we did in our first webinar was we explained the consumer value chain. There we had shared retail, which really looked at discount stores or mass merchants, household and personal products, which is consumer packaged goods, and the chemical industry. And what we saw in bold are the correlation of the formulas for those particular industries. What I found interesting, Abby, about this was that we were able to actually get a fairly high correlation of these combinations of ratios in a formula, but I actually found that it was interesting to see how different the ratios or the metrics that matter were by industry. Were you surprised by this as well?
I was. I think we know inherently that supply chains are different, but this was really a statistical test that showed us how different the equations are for these three industries that work so closely together.
And I think one of the things that we don't have clarity as we deal with collaboration is how do we align these metrics that matter. It's interesting to me that, you know, in all of the correlations that we've done, you know, we're seeing operating margin, but we aren't necessarily seeing return on assets with any other industry other than the chemical industry. So I think that's very interesting. And so let's talk about what we're going to share today. So today we first looked at consumer value chains, and today we're looking at the healthcare value chain. Tell us what you did here, Abby.
Today we have 6 new equations, and they're listed on the left as the Morningstar peer group. And so we've come up with an equation for the major drug manufacturers, the specialty and generic drug manufacturers, medical care, which would be hospitals, medical devices, medical distribution, and medical instruments and supplies. And then on the right-hand side, you can see some logos of companies that are within these peer groups to help people orient within the space.
So it's a very fragmented industry. And, you know, we've got the pharmaceutical value chain, which medical care, people can think about hospitals, medical distribution. Of course, you know, we have Cardinal Health or McKesson, pharmaceutical major, which, you know, we would think about Merck or Abbott, pharmaceutical generic. It's very interesting to me, Abby, that we're able to get good correlations for most, but we weren't able to get a good correlation for pharmaceutical generic. Tell me a little bit about that.
So we struggled to find a larger R-squared value, which you can see in the bottom of the table, measuring the correlation strength. And pharmaceutical generic has a R-squared value of 0.35, where 1 would be perfect correlation. And the problem is that when we get such complex equations, you can see pharmaceutical generic has about 10 independent variables. It's very hard to find those strong correlations and get a higher R-squared value.
So what do you see in these particular metrics that matter? You know, what pops out to you as you look at these in this particular industry?
Sure. I think across this value chain, you can see that there are some metrics that pop up over and over again. Just as in the consumer value chain, you see operating margin, return on invested capital, and days of inventory or days of payables. They seem to pop up a lot. I think the other interesting thing is the large difference between the two pharmaceutical peer groups.
Now, just for the audience, what's the difference? Can you just capitalize on what's the difference between ROA and ROIC?
Sure. So return on assets is a ratio that measures net income divided by total assets. And then ROIC, or return on invested capital, ties it back to shareholder equity. And so that's the division of operating income divided by total liability shareholder equity.
And return on net assets, how does that differ than ROA?
So return on net assets takes into account the physical assets of the company, the property, plant, and equipment, and it subtracts out current liabilities. So it's similar to return on assets, but they actually do pop up separately within our equations.
Okay. So that's the pharmaceutical value chain. Now let's look at the medical device value chain. Quite different, huh? Much more complex.
Yes.
What do you see here?
I think you're spot on with the complexity. Here, almost all of the industries, and you'll notice we've kept medical care and medical distribution. Those are the same as the previous slide, but medical devices and medical instruments and supplies, just like that pharmaceutical generic, they have a long list of independent variables.
So there's not as high a correlation, and the impact of supply chain is not as big. You know, supply chain is a piece of market capitalization in those particular industries. But we can still see, you know, some key asset intensive operating margin metrics. But let's look at the individual equations. So here we have medical care, which are the hospitals. And it looks like in this fragmented industry, you were able to get a fairly high correlation. Anything you want to share here?
Yeah, I think when I look at this equation, I see the importance of cash flow. So if we look at some of these abbreviated metrics, FCF would be free cash flow, and WC is working capital. And so both of those metrics, I think, highlight the importance of cash flow within the hospital or medical care industry.
And interesting, this is the first equation we've seen where year-over-year growth correlates, which we thought when we first started that year-over-year growth would have a very high correlation. Did you find that interesting as well?
Yes, I think I expected year-over-year growth to show up in every equation. It's only showed up very sparsely.
So who did it best? If we look at the medical care ranking for the hospitals, what do you see here? Any thoughts?
So here we were able to take the 2012 annual performance of these companies and plug in those metrics into our equation, and we were able to come up with the rankings. And on the next slide, we've highlighted the performance of the top 5 so we can see how they did on each of those metrics. and why they scored where they did.
And Abby, one of the things that this has been very helpful for me is, you know, balance, this whole concept of balance. No one company does the best in everything, right? And it's really the balance of these metrics. And when I look at the data that we finished for consumer packaged goods and I look at leaders year over year, they've been able to keep balance. And I don't see in the healthcare industry that we have as strong a leaders year over year. Would you agree?
I would agree, yes.
So let's move on. Now, medical distribution. This is, again, folks that do the distribution of materials to the hospitals. Any insights here from the equation?
Yeah, I think this is where we see operating margin pop up. And so that has played, I think, looking at this slide, we would expect it to play a really large role. But if we look at the rankings, there's actually an interesting story to tell there.
Well, let's talk about the rankings. What's the story here?
So if we go to the next slide, we can see the performance of the top 5. And if we look at operating margin for McKesson, who ranked number 1, you'll see how much lower that is than, for example, Patterson companies, who ranked number 4. So their operating margin is almost 10 times smaller at McKesson, but because of their performance on these other metrics, they've been able to balance it and to come out on top.
So a real case study of balance across the metrics and the balance between profitability and cycles. I mean, if you look at the ability to manage inventory or the ability to manage, you know, DPO versus DSO, you can see real balance there. Fascinating. Okay, let's talk about major drug manufacturers. This is big pharma. You know, here we saw a pretty good correlation, but here we've got the Altman Z. We've got the indication of risk. What do we find here?
So here we have a relatively simple equation. This compares in my mind to the chemical equation, which we presented last month, and also had a limited number of independent variables. But the drug manufacturer major equation does have Altman Z, and because it's a calculation of several different raw metrics from the balance sheet and the income statement, it's not yet available for 2012. So we haven't been able to complete the rankings. We're waiting on that 2012 Altman Z score to be able to rank this industry.
And hopefully we'll be able to do that in June. And, you know, when we look at the generic equation, again, here we're not getting very high correlation. So supply chain is playing less of a role here, but again, it's a whole complement of metrics. And this is a very fragmented industry as well. Thoughts?
Yeah, I would agree. I think that, you know, in my mind, I thought that the two drug manufacturers would have relatively similar equations, and I couldn't have been more wrong. So here
right. I think a lot of people are. Yeah, sorry. I think a lot of people are like that, Abby.
I think we have a long list of metrics and not a low correlation strength, like you said.
Yep. All right, let's move to medical devices now. Now, you know, a lot of people will think that big pharma and medical devices are similar, but, you know, they're anything but. I mean, here we're not getting a very high correlation on medical device, and we actually see that, you know, it's very different from pharma. What do you see here?
So in this equation, we have both return on assets, which I've abbreviated ROA, and then return on net assets, which is RONA. And I've had several questions from people who were able to attend the last webinar about if these metrics were duplicates of each other, and here they're both showing up, but actually in other equations, either one or the other will show up. So I do think that they're complementary and they're not necessarily duplicating each other. But again, we have Altman Z in this equation, so we haven't been able to complete that 2012 ranking for the medical device companies.
Now, when we look at medical instruments and supplies, it's pretty similar, isn't it? I mean, you know, it's again, it's a fairly low correlation, a wide definition of the equation. Any thoughts here?
Right, and also in this equation, we'll see that year-over-year revenue growth, which is abbreviated YOY. And I think that this is about the third of 12 industries where that has proved meaningful and had a correlation to market capitalization. So much less familiar than I would have expected going into this.
Okay. So let's talk about the so what. You know, why do we care, right? So, you know, we talked about consumer value chain, and as we looked at our value network relationships, that knowing the metrics that matter help us to better align. And as we think about the evolution of the pharmaceutical value chain, I think it's important here because, you know, we have not been able to reduce total cost or working capital across the value chain to really focus on how do we raise the bar and the potential across the value chain. And, you know, it looks like that we get clear alignment on operating margin, on our ability to really work on days of inventory, DPO, DSO, and the recognition that each of the companies are different. Any thoughts here, Abby?
Yeah, I think I would agree with what you had just said, that, you know, you can work better with your partners when you understand what they're working towards as well.
And the same thing in the medical device manufacturing arena. You know, the interesting thing is that a supply chain plays a significant role in all of the ratios and the equations that we've done of 11 sectors, and not for 3. And so as we look at this, I think it's really important for us to step back and look at all the equations. So what we're doing at Supply Chain Insights is we're beginning our continuation of the march to do all of the Morningstar sectors. Today we shared insights on the healthcare value chain. Next we're going to be doing apparel, and we're going to be doing drug retail, and we're going across the sectors. And if you're interested in, you know, our schedule, we'd be glad to share that with you. After we do that and we rank all companies within the sectors, what we're going to be doing is looking at which companies have outperformed others. We will then be looking at what processes allowed them to outperform. And we will then be able to share that at our conference on September 11th and 12th. So today, you know, as we think about the so what and who cares of the work we're doing on the supply chain index, there are a couple of things that I'm taking away from the research. First of all, it's silly to put all industries in a spreadsheet and shake them up. What drives value in each industry is very different. The supply chain definitely has a correlation in 70% of the Morningstar sectors that we have done so far. However, the ratios that matter are very different. The financial markets reward balance. You know, it isn't just a singular metric. I work with a lot of companies that will look at inventory and absence of operating margin. And instead what we see is the companies that have really powered the most significant market capitalization bumps have balance across the metrics in the portfolios. And only in certain industry sectors are we seeing that certain companies are able to outpower the others in the ability for balance. We see that with Walmart in retail. We see that with Procter & Gamble and CPG. We do not see that in the chemical industry. What we see in the chemical industry is that companies have looked more at singular metrics, and therefore we do not have the balance, and we do not have the potential that we see in the first 2 industries of mass retail and consumer packaged goods. And the healthcare industry, the industry we've just talked about, we talked a little bit about medical distributors, and there we can see the impact of balance. But in the rest, we're seeing a very young new industry that is maturing. It's fragmented. Supply chain practices are not nearly as mature as we're seeing in other industries, and so we are not seeing any company really pushing the envelope on raising the potential, and that is, I think, a discussion all on its own. We're not quite finished yet. We don't have all the Altman Z data, but we're clear on the metrics that matter, and we will be putting that out in a report in the summer period. But this idea of the supply chain as a complex system, you know, we've got to understand the metrics that matter, and we've got to be clear that we're aligned cross-functionally on those metrics that matter, and we've got to tie the supply chain processes to the balance sheet. So many times I go into a company and I talk about this and they're not clear, they're not looking at the balance sheet, and so we've got to carefully define it, and then we've got to connect it to our value chain relationships. There is no substitute for leadership for doing this, and we're finding that supply chain excellence matters 70% of the time. Abby, thoughts here as we close?
Yeah, I think that there's a lot more work to do, but it's been interesting to see the differences between the industries and how supply chain has an impact on their performance in market capitalization.
Well, thank you so much, Abby, for your hard work. And you know, you can continue the discussion in our supply chain community. We're hoping to see you at our Global Summit, which is coming up in September in Scottsdale, Arizona. We'll have all of the Morningstar sectors done. We'll have the leaders who have done the best in powering supply chain balance and potential speaking, and we will be able to share latest research on things like big data and the use of social data into the supply chain, digital manufacturing, the role of talent. We're hoping to see you there. It's really reserved for 150 supply chain leaders. It's a unique event. It doesn't have any vendor booths. It doesn't have any paid speakers. It's really about research. It's about the supply chain index. It's about how we improve market capitalization through supply chain excellence. And we're continuing our web series throughout the months. We've got a great lineup for sales and operations planning. We're releasing research based upon over 100 respondents on sales and operations planning. Sign up for that webinar. We have both Interis and Avaya speaking and giving their insights on the S&OP. We also have a continuation of the supply chain index as we reveal apparel and food and beverage in June, and we have our big data webinar in July. And of course, we have our on-demand webinars. If you want to share these with people in your groups, feel free to do that. We want to keep the discussion going, so join our community where you can blog, you can share this research. We want people to share the research freely and give us feedback on the index. So, you know, continue the discussion also in our blogs. You know, my blog is Supply Chain Shaman, and Abby can be found at Supply Chain Index, and follow us on Twitter. And we appreciate your time today. Constance, were there any questions?
Well, great, Laura and Abby. Thank you so much. And I'm going to remind the audience, if you have any questions for Laura and Abby, please feel free to chat them in the Q&A section. We do have a couple of questions, Laura. First of all, how can I apply the index to my own company?
Well, I think what you need to do is look at which Morningstar sector you're in and look at the metrics that matter for your particular industry. So let's take the chemical industry. It's a pretty simple formula. I can sit down and I can look at that industry. I can look at which metrics that matter, and they're very different than, say, consumer packaged goods. And I can align my horizontal processes against those metrics that matter, and I can look at how well I've performed on the balance sheet against my peer group. And if people wanted help on what that benchmark looks like, we'd be glad to help them with that.
Great. Another question, how does the index incorporate ideals such as leadership and innovation, which are so important to supply chain?
Well, I mean, you don't increase the potential without leadership, right? And you don't have balance. And you're not going to be able to have growth without innovation. And we actually see that the people that have outperformed their peer group in some of the Morningstar sectors that we talked about in consumer packaged goods have been innovators. I mean, Walmart was innovative in the introduction of Walmart Retail Link. You know, Procter & Gamble designed the consumer-driven value network based upon the 2 moments of truth. So we see that, where there is the highest potential, where people have truly outperformed their peer group, there usually has been innovation associated with the processes, and it's helped them to increase the potential.
Great. Another question, what was the most surprising observation in the healthcare equation formulation?
Abby, how about yourself? What do you think?
I think the most surprising insight for me was the difference between the two pharmaceutical companies, the peer groups. I keep coming back to that, but that was very surprising to see similar peer groups and what I would think would be similar operating environments, and how different those metrics are, and how those companies need to alter what they're measuring and how they're working with those upstream and downstream partners as a result.
Well, great. Okay, it looks like we're going to start to wrap up here. Laura and Abby, thank you so much. And as we have a slide here on our PowerPoint deck, the Supply Chain Insights Global Summit, Laura, I believe we're going to have some top companies presenting at this event. Do you want to tell us a little bit about how you're selecting these speakers for the event?
Right. We're launching the agenda for the summit the 1st of June, and the speakers at the summit are going to give their perspectives on the supply chain index over the last decade, and they're the companies that have shown the greatest potential against their peer group in the year-over-year analysis. I'm not ready to tell people who those companies are yet, but their stories are quite impressive.
Excellent. All right. Laura and Abby, thank you so much. And to the audience out there, thank you so much for joining us today. Be sure to join us on June 27th for the next Supply Chain Index webinar, where Laura and Abby will share the work they have done in the apparel, food, and beverage industries. On June 13th, be sure to be with us for the Sales and Operations Planning State of the Union webinar with our guest panelist, Benji Green, Director of S&OP Demand Planning for Avaya, and Jack Lyon, Vice President Operations Enterasys. Visit www.supplychaininsights.com/upcoming-webinars to sign up for these and all of our upcoming webinars. Thank you again for participating in today's Supply Chain Index Part 2 webinar. We will see you next time. Have a great day.